Welcome to Macquarie Conversations with Bilal Hafiz. Macquarie uses natural and artificial intelligence to educate investors and provide actionable insights for all markets, from rates to FX to commodities. For our latest insights, visit macquarie.com. Before I start my conversation with this episode's guest, I have 3 requests. First, please make sure to subscribe to this podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave some nice feedback and let your friends know about the show. My second request is that you sign up to our free weekly newsletter that contains market insights and unlocked content. You can sign up for that at macquarie.com. Finally, and my third request is that if you are a professional or institutional investor, do get in touch with me. We have a very high-octane strategy and analytics offering that includes access to our world-class strategy team, market views, AI models, and much, much more. You can email me at bilal@macquarie.com, or you can message me on Bloomberg for more details. Greetings and welcome, Paul. It's fantastic to have you on the podcast show.
Hi, thanks very much for having me.
Now, before we go into the meat of our conversation, I do like to ask my guests something about their origin story. So in your own words, what did you study at university, and was it inevitable you'd end up in financial markets?
So I did study economics and politics at university, but it wasn't inevitable I'd end up in finance. At least my thinking when I was 21 or 20 was that. So everyone I knew was going into finance, so applying for like city jobs in the UK and all of that. And I was like, I don't want to do that. So I did this subsidiary course when I was at university on Chinese history, and the professor was really good. And I'd spent some time in Russia, been to Russia on a school exchange, and thought Russia was interesting. But when I got there, wasn't so attracted to the place. And then I got interested in China through this subsidiary course. And anyway, so everyone was going into finance. I was like, I don't want to do that. So this professor, the Chinese embassy at that time there was a list from the Chinese, and this was back in 1994. So the Chinese embassy, there was a list you could get from the Chinese embassy of colleges in China that took foreign teachers. So this professor went through and said, oh, you don't want to go here and here. And I ended up with like a list of 20, applied to all of them. And then one of them ran me up at like 3 a.m. on a Sunday morning and said, come out as soon as you can. But I didn't speak any Chinese, and I didn't really understand Pinyin. So they said the name of the school. I had no idea where it was. So I had to wait for a letter for them to come. Anyway, so went to China for a year. It's quite hard work. Especially not knowing any Chinese. And, I was in an inland city in the Henan province. So, if I'd known then, it was like the inflationary boom of the 1990s. So sort of economically quite interesting, but it's a very poor place, very underdeveloped, very different from my life in the UK. So
what year was that when you went there first?
It was 94 to 95.
Okay, so that was the big deval year.
Yeah, exactly.
Around that time.
So
Yeah,
that
was a huge period. Yeah.
So coming off like the end of Deng's war, and then that big inflationary boom and all the investment and all of that. So interesting time, which I was completely ignorant of because I knew nothing about China. So I spent a year there, got interested in China, came back, started studying Chinese. Was lucky enough to get a job at the Economist Intelligence Unit, was there for a while in London I was the most junior person on the team. So I was doing like Tonga and Fiji, Papua New Guinea, a bit of China. Then I went to Taiwan for a couple of years to study Chinese, went back with the IU in Hong Kong, and then got a job on the sell side, and then got a job on the buy side at Wellington. And then COVID happened, moved back to Taiwan, and then set up my own company. So the finance stuff, I was lucky, right? Like China was this great sort of macro story. There was a lot of demand for it. I doubt I could get a job doing finance if I was taking that same route again, right? Like if I was trying to do it now. I think
many of us feel that who've been around for a while. The entry requirements are quite different to our day, I think.
Yeah, I didn't do internships or anything like that, right? Like I spent all my time traveling and spending all my money, like traveling around. So, so I was lucky anyway, and then ended up in finance, and it's been a very, very rewarding career. It's been very
And
good.
then at Wellington, you had a fairly long stretch there. Can you talk a bit more about what you were doing there, what your regional focus was?
Sure. So I was, first of all, 7 or 8 years at Macquarie as head of China economics, so on the sell side in Hong Kong, living in Beijing and Hong Kong at that time. And then 2012 joined Wellington. So I was working in one of the fixed income teams. It was a global macro team. Largely, it was, trading mainly US and European markets. So I was the only one in Asia, particularly to begin with. So trying to kind of, educate and interest people in what was happening in Asia. So I was there for 8 or 9 years. So a couple of years in London, a year in Tokyo, and then the rest of the time in Hong Kong.
Okay, that's great. Okay, now, obviously, right now, over the past few days, China, US has been front of mind for everybody with all the news that's come out. I should give a timestamp for our audience, given how fast moving this news is. But it's we're recording this on Tuesday, the 14th of October. But essentially, last week we had the news from China that they're going to restrict their exports of rare earth metals. And this, I mean, the market took this quite negatively, because the market was essentially priced for kind of a friendly US-China trade talks, since the Madrid-London talks. It seemed like we were on a track where, a lot of the noise had gone away and it was following a path. So, I mean, can you give some context for this escalation? Were we misguided to think that things were smooth before Friday?
Well, on all of these Sino-US things, particularly when you're trying to comment on the China side, it's very difficult to have, nobody has an inside read on what the negotiating strategy is, right? Going back, if you remember like the first trade war and the breakdown of talks and all of the information that came out was, coming from the Wall Street Journal. Like you don't get the kind of the coverage on China. So I think we need to be careful in terms of, trying to give ourselves too high marks or think we can have a lot of foresight on what the negotiating strategy is. That said, I think the tone coming out from China over the course of the last few months has been they have the upper hand. And even if, Trump denies that Paco trade himself, I think, China itself has begun to believe in that. And I think in that context, this looks like a sort of turning of the screws, right? Like before the meeting is supposed to happen at APEC, that they think, my sense was they think that they have the upper hand and that this is a way to try to get higher feedback from the US side. And if you remember, the other thing I think is important that's been in the media over the course of the last couple of months is the sense that in this process, Trump and the US administration is also willing to change relationships with Taiwan in that process, right? So if that's the context, I think you have to expect that China thinks like, they're willing to make big sacrifices here to get a deal. If that's the case, we should sort of go for broke. So, I don't, again, I'm not claiming great foresight that I expected this to happen, but I think the context, makes some sense. Now, obviously, the risk is now that he's overplayed his hand, and he's made a step too far. And you would think that the kind of the parallels of the weaponization of the dollar and the risks of doing that. There is definitely parallels with that and China's approach to rare earths for the rest of the world, not just for the US, that the rest of the world gets really scared by this kind of approach that China is now taking. But in terms of negotiations with the US, I think this is their strategy. And I think now it's really, is Trump himself, does he think this is a step too far and he's going to, throw the baby out with the bathwater? Or does he think, that there's still a deal to be done and that's really what he wants? And I think my guess would be the latter, but I think again we're in this period of both in Japan and in China right now, like a big period of volatility once again.
And you mentioned earlier about China believing they have the upper hand, and this goes to a larger question which people in the financial community have been debating, and you see it, expressed in the media as well, around who does actually have the upper hand here. Because one argument is, okay, China's got an amazing manufacturing capability, supply chain, and all of those sorts of things, and they have a different political system which allows them to weather lots of storms, so they have the upper hand. But then on the other hand, the US, you can make an argument, the US is the biggest consumer market in the world. And China has been relying primarily on exports for its growth. So actually, the US has the upper hand. So where do you stand on that? Like, who has the upper hand here?
So I think right now, I think so. Obviously, the two economies are very heavily interrelated, and so they can both drive each other down. But I do think what is clear at the moment is China is better prepared right now. Like I think that's something that I think we can all agree on, that they've been, they saw what happened, and you look back to sort of 2017, 2018, the first trade war, like China was much less prepared for that. And we could see the reaction in the financial markets and what happened with the CNY and so on. This time around, I think it is reasonable to be thinking that over the course of the last 4 to 6 years, they've been preparing for this moment in a way that Trump and the US administration were not doing, or at least not in the sense of like battening down the hatches and getting all their sort of ducks in a row. So I think at least right now, China is better prepared for the fight that's going on. Going forward, it's clear that a lot of the growth in China over the course of the last year, couple of years, has happened through exports. Now, we're seeing a lot of export diversion, right? So China's export growth has been phenomenally strong, particularly in volume terms over the course of the last couple of years. That has been, if you look at the data yesterday, right, like it's not missed a beat despite the fat tariffs, right? Like the trend is still very strongly upwards. And that seems very unsustainable. Seemed unsustainable 6 months ago, or it seems even more unsustainable now. So I think the stuff coming out with the US hurts China. They're better prepared for it at the moment. They have a bit of leeway, but ultimately this is going to be a negative for China's economy because of the export side.
And on the economy, I mean, for years now, we've been talking about the lack of domestic demand, or especially the consumer side in China, that they need to do structural reforms. They need to move away from overproduction. They focus too much on supply side things. And then on top of that, people throw into the mix that China is following the path of Japan in the 1990s. So there's a Japanification of China. What's your take on that?
So I think there's two things we could sort of discuss there, or there's a lot of things, right? But like, at least in terms of your question, right? So maybe first of all, just to think about where China is now. And one other thing, clearly one of the big problems with the economy, the big sources of weakness has been this collapse in property activity since 2020, 2021 with the 3 red lines. Now, I think it is important that you can actually point to 3 things. So property starts is one. Household deposits, the ratio of household deposits that are held in time rather than demand, and looking at interest rates generally, like all of those things look like they're bottoming out. So it's not to say that growth is coming back, but in a sense, we're one stage through the process of China weaning itself dramatically off. Weaning is probably not the right word, right? But like suddenly jettisoning the property market as a driver of growth. That process was important, has had a big impact on growth the last 2 to 3 years. But in terms of the second derivative impact, the worst is now behind us. And I think that's important for thinking about the economy today. The second thing on the Japanification thing, like I think there's maybe 2 things to talk about. So the first is, and again, I think it's really important, and I think it's underappreciated when people look at China today, that when you look at one of the big reasons why Japan got in such a mess was in the first half of the 1990s after the bubble burst. So people remember the yen went up a ton during the 1980s, like during the Plaza Accord and all of that. People don't realize that the yen continued to go up almost vertically in the first half of the 1990s, not just in nominal terms, but in real terms. So there was a real appreciation of about 65% or thereabouts between 1990 and 1995, when Japan was already in deflation, right? PPI started to fall from 1991. So this was like I think a sort of classic high real rates, high real exchange rate, reinforcing deflationary pressure that was coming out of the bursting of the bubble that the authorities were too slow to react to. If you think about China today, it couldn't be more different. There is the deflation side, fine. But when you look at the exchange rate, right, the exchange rate is 20% cheaper than it was at the peak in 2022, and is now as cheap as it was in 2012, 2013, despite the fact that the export sector is doing phenomenally well, as we've discussed, and that feeding into this very large trade surplus. So that, I think, is a critical difference in understanding the difference between China and Japan. The second thing then is the BOJ had this report, right, like in at the end of last year. So Ueda's sort of pet project, it seems, his baby of like looking at this long-term review of monetary policy. And the interesting thing about that, and the reason I'm talking about that separately, is because it started in 95, right? That was their terms of reference. It was from 1995 until now. So they missed out all of that stuff about the exchange rate, which is sort of interesting, right, when you think about it. But that report, I think, is interesting because it basically gives you a checklist of what caused Japanification in Japan above and beyond that exchange rate stuff. And if you go through that report, you can end up with about like 15 different points, right? Like of things that they identify as causing Japanification. And if you go through that and, tick China for each box, you basically only tick 2 or 3 boxes, right? Like, yeah, the property market is very weak. There's been a problem with asset markets and they have deflation. But all of the other things the BOJ talks about, so things like the level of prices being very high to begin with, China doesn't have that, for example. Like it's not suffering from a big increase in import penetration, right? Import demand in China's going down, it's not going up. Like there's a huge amount of import substitution. So you can go through that list and essentially you kind of conclude it doesn't really look like Japan at all. So China has problems, right? There are things going on in its economy. But I
mean, well, what about bad debts? I mean, that's one of the things people point to in China. I mean, there's obviously some opacity there, but that was one of the problems we had in Japan in the 90s. And then the bad debt, impinged balance sheets. You kind of had the balance sheet dynamics there, which caused a lack of credit creation. I mean, isn't that like one of the overarching kind of dominant factors?
Yeah, and so that is an important one. And as you said, the opacity, right? Like politely about China's non-performing loans, right? Like so, yeah, it presumably is very bad, even if we don't have the data. That said, and I think one of the things that you did see in Japan was there was a real relationship between that and lending growth, right? Like the problem was that this caused a credit crunch in the economy, coupled with the fact that companies were all like had too much debt, they couldn't borrow, so therefore they had to pay down their loans, and you end up with that classic balance sheet recession. Like in Japan, right, in China, that's not happening, right? Like I mean, at least like if you believe the data, there's been the almightiest boom in investment lending, like to the manufacturing sector. So it's sort of the opposite, right? And actually the flow of funds data, like it's released with a bit of a lag, but we have the data from 2023. So if you're looking for that classic balance sheet recession of companies moving from a net borrower position to a net saver, in China, there's zero evidence of that happening. Now, maybe it should, right? So to your point about the financial sector being too weak, and this is a problem that's being stored up for later, but it's not apparent in the way the economy is functioning right now. And if you do want to make a comparison between Japan then and an economy today, the economy where that sort of balance sheet recession stuff on the corporate side becomes much more relevant, I think, is Korea today rather than China, where in the data, there is a bit more evidence of that sort of shift, whereas in China, there isn't. So I think, again, in China, like it's popular to talk about Japanification. It was one of the things I think that fed into this market narrative and meant that equity sold off a lot, and particularly interest rates came down, right? Because if you believe in Japanification, interest rates are going to zero. But I've been very skeptical about that, and therefore, particularly with this bottoming out of the property market, think that probably we've seen the floor in interest rates.
And then more broadly with the China economy, one can almost characterize it as you have certain sectors that have huge state support and are really vibrant and doing very well, seeing lots of investment. That's the EV, battery, semiconductor sort of sectors. So that seems to be very sort of vibrant, and the stock market reflects that to some extent, AI and those sorts of things. But then the rest of the economy seems relatively weak, and hence the reliance on exports. Is that a fair characterization of Chinese economy today?
I think so. I think I'd buy into a lot of that. I mean, I think the one sort of nuance where I think I disagree with the consensus is this idea that consumption is much weaker now than it was before COVID. So I mean, I think consumption structurally is a smaller part of China's economy than is another economy. But in real terms, it looks like consumption has basically got back to very near the pre-COVID trend. So retail sales are a terrible measure. I mean, like everyone uses retail sales because that's the only thing that's available on a monthly basis, but it's a terrible measure of consumption, I think. And if you use the broader measures of consumption, it's basically back at trend. Now, the problem is with that the trend was slowing before COVID. So in a sense, it's sort of cheating, right? Like well, you're back at trend, but it wasn't a very good trend to begin with. And the second thing is particularly with that decline in the property market, that relative weakness of consumption matters much more now, because it's not, there's no sort of replacement in terms of aggregate demand coming through. So I think that's been, the kind of the story. And then in a sense, then the big challenge, and this is sort of well known, but the big challenge, and actually you can sort of put it this way, right? Like if you look at consumption, like the savings ratio today is basically the same as the savings ratio before COVID. So consumption hasn't changed. What has changed is that savings were previously being used to buy property. So in a sense, savings were being mobilized within the economy, helping to drive inflation, to drive activity. What's happened since COVID is, without the property market, those savings have come back into the banking sector, increasingly being saved in time deposits rather than demand deposits, which means M1 growth also slows down, and you get that kind of deflationary impact coming from that. So the question really is, like, how do you mobilize those savings? And the interesting thing is, particularly in the run up to this, the next 5-year plan is going to be released right over the course of the next week or so. So there's been all this talk about, is it going to be something on the services side or in terms of welfare? And the interesting thing is, there clearly are, it's not just sort of the wacky foreigners like saying that, the government should spend more on welfare and, that kind of thing. Like, there's clearly a big domestic source of debate around that as well. So, it'll be interesting to see if the government does talk more about that. But I think it's sort of it's critical that some measures taken to mobilize domestic savings in a way that the property market was doing before, and that hasn't been substituted since.
And on that, I mean, many people over the past year or so, we constantly look for some kind of stimulus package. Every 3 months we look for some kind of stimulus package. So in the context of what you just said, what would you say would be like a good stimulus package, as in would exacerbate some kind of cyclical rebound? And what would be a stimulus package that is just what we could just ignore because it's just, relabeling things that were already been done before?
Yeah, I mean, in a way, like, that's how I felt about the September stuff last year, right? Like, that it was like, I found it very, I mean, and obviously it was sort of wrong in the sense the equity market went up a lot, although it didn't persist at that time. But, like all the stuff, right? Like, it was like, okay, finally the Fed is cutting. There was that great expectation, right? Like, China's all about, it's all about the dollar and the Fed. And as long as the Fed cuts, and that's going to give room for China to move. And then they come in and say, yeah, we're going to cut interest rates by 10 basis points. It's like, that's not particularly interesting, right? Like, it's incremental change. It's not like using that opportunity to try to take the economy in a new direction. So certainly, I think if it's like, a reserve requirement cut, interest rate cuts, like, it's sort of, that's been that's been where they've been in the course of the last 3 to 4 years. I think it's the kind of the most exciting thing would be some special bond issuance to fund local government spending more on education and healthcare, with the government using that to say, this isn't an increase, we're not spending on consumption, we're investing in human capital, right? So it doesn't, so I think this idea that like they're kind of stuck with this anti-welfarism thing, like there's obviously something in that, but I think there's ways around it depending how it's talked about. And I think if there was this sort of, they did do something on some significant borrowing to finance welfare spending for migrant workers, including some reusage of excess housing to put them in better quality accommodation, right? Like, you can see how that would be very popular domestically within China. You can see how it would be very effective economically, because these people have a low savings ratio compared with people who've got tons of money. And you can see how it helps with the economy because it stabilizes the property market at the same time as hopefully boosting consumption over the longer term. So that would be sort of my, the thing that would sort of get me excited. But it doesn't seem particularly likely, so I guess I'm not going to be excited for a while.
And then in terms of what this means for interest rate markets, should interest rates, like long end rates, go down, real rates go down, PBoC is cutting, so you could make that argument, but then actually there's a cyclical recovery going on. And then equities, obviously, they're doing very well. Do you have a take on markets?
So we do some think about this the last couple of days. So one of the things is kind of like, in a sense, so I think I would argue that monetary policy has worked reasonably well in China over the course of the last 2 to 3 years. Now, part of that is sort of that parallel with Japan, where monetary policy really didn't work well, right? Like they couldn't ease policy at all, couldn't ease conditions at all. Whereas if you think about in China, you you would think that real interest rates are rising in China because there's deflation and they can't cut interest rates quickly enough. But the exchange rate at least isn't acting as if real interest rates are too high, right? You're not seeing that kind of like, and obviously it's partly because China's not a safe haven. It's partly because there's capital controls. Like there's reasons why it behaves differently to the end. But nonetheless, from an economic perspective, like it doesn't look like real interest rates are too high in the terms of kind of how the exchange rate is reacting. It also doesn't look like interest rates have really been too high given that boom in investment in manufacturing that's happened. Now, again, some of that's corporate, government directed and other things, but still, like it's kind of like the way the economy works. And I think I think my sense right now is, again, I talked about this a bit earlier, that I think interest rates have probably bottomed from a sort of structural perspective because the property market looks like at least, 90% of the correction is done. Like it doesn't mean it's going to get a lot better, but 90% of the correction is done. At the same time as the big thing that has moved over the course of the last 2 to 3 years is sort of a bit of an expansion of the PBC's balance sheet, at least in terms of increased lending to the financial sector. And that's one of the things that's kept low, real interest rates, nominal rates at the short end quite low. So I think there's reasons to think that the economy is bottoming out sort of cyclically. And for the first time, I have this, it's a bit, as everything in China, it's not like mathematically fantastic, but I have this thing of like trying to look at, what's the PBC reaction function, like just related to, what happens, what drives interest rate changes and reserve requirement changes in China. And for the first time, that's now saying that the risk of further easing is declining. So we're sort of, again, it's sort of one of those things that suggests with what's happening with the property market that maybe there's a turn like happening. Now, that's not going to persist if the trade war leads to a big problem with exports and this investment boom that's replaced the property market boom now collapses. So there's things to worry about. But I think, again, for the first time in sort of 3 or 4 years, there's some signs that things are changing cyclically with some of these fundamentals in the economy. And I think that's quite important. And again, there's, for a reason to thinking that rates probably we have seen the lows.
Okay, let's switch over to Japan. I mean, we've talked about Japanification, but what about Japan? We recently had elections, first of all. Do you have a take on that? We had a victory, but seems like the coalition is falling apart as we speak. So it wasn't definitive in some way. So maybe we can use that as an entry point to sort of Japan. I mean, what was your take on what were the issues driving the election? Why do we have these unstable coalition dynamics? What's sort of the broader picture here?
So I think the number one issue in the election is really prices, right? Like it's the cost of living squeeze for ordinary people in Japan, which is very visible because inflation, as much as the BOJ likes to say, likes to question what the underlying rate of inflation really is, and you can have some sympathy with them trying to get to that. But nonetheless, from people trying to buy food and the rice price goes up by 100%, like they're not going to feel very happy about that, right? So, and I think that has been the number one issue, and you can see it in the advances that have been made by the opposition parties at the last couple of elections, right? Like what's been one of their big selling points? It's like, well, there's a cost of living crisis and we need to do something about the household sector. And in a way, and if you think about that in the context then of the rumblings around some of the people purported to be advisors to, the Prime Minister hopeful, and they're saying, well, like a weak yen, it's fine, right? Like Japan can have a weak yen, it's okay. Like it sort of seems to me that it just doesn't hang together at all at the moment, right? Like, okay, if you're going to do something on the fiscal side that's aggressive, that compensates consumers, and you have a weak yen. Well, fine, maybe somehow that hangs together, but the timing is really important, right? So what you have at the moment is just a much weaker yen without having any of that fiscal support apparent. And the fiscal support is going to be much trickier now because of all the political instability that they have. So I think my first reaction to particularly the market over just after the election was, this doesn't make any sense, right? Like this kind of like, the market going up and the yen depreciating further, like it exacerbates the issues that's causing the LDB to be unpopular in the first place. So that's, I think, one thing. The second thing is then now there's this like array of different, commutations that are possible about who's going to form the government. And obviously, like all of that horse trading, it's even worse than trying to predict like what Xi and Trump come up with, right? Like what's the end result is that going to be? I think we can identify what would be helpful for Japan and what would work for the economy, and particularly in terms of thinking about what the BOJ does next, about what would put the BOJ on a firmer path. And I think that is one thing that somebody in the government coming out saying that the BOJ should make its own mind up, right? Like, so at least they can focus on inflation and the market can think about that in that sense rather than having to worry about the politics. But then what do the politicians need to do? It's doing something about the falling household share of GDP, right? So you can, and actually, so there is sort of an interesting story about consumption in Japan. I think that as much as the cost of living is the number one issue when people go to the ballot box by all accounts, actually, if you look at consumption in the GDP numbers on a per capita basis, consumption is not too bad. On an aggregate basis, consumption is very weak. So the economy looks very weak because we're not having aggregate increases in consumption. But on a per capita basis, it's quite good. And obviously the difference between those is partly because the population is shrinking, right? So like the market's sort of given up thinking about demographics in Japan just at the time that demographics are becoming very evident because the adult population is now trying to shrink and therefore consumption is starting to come down because of that reason. But the other reason why aggregate consumption is so weak is because if you think about the three things that drive household income, so wages, incomes from financial assets, and the third thing, incomes from the government, all of those things have been under pressure, not just the last 10 years, but for the last 20 to 30, for at least for the last 10 years, but some of the things going back beyond that. And so I think from a sort of policy perspective, the thing that would work both economically but also politically probably is something that tries to address that. And that is partly patience, because, like one of the reasons why the household share is low is because the wage share, the labor share of income is low. Now, you would hope that because of the shrinking of the population and the labor force peaking out, that the marginal return to labor starts to rise. And so you see that kind of labor share. I mean, labor share cyclically is a very low point. So, even cyclically, there should be a rebound. But structurally, it's all about that. How easy is it to substitute labor with capital? And if that's going to be difficult, and in some industries it clearly is, then the labor share should start to rise. The second thing we're seeing it already, right, in terms of rentals, interest payments, like returns on the stock market. For the first time in 30 years, the kind of the income financial assets for households is starting to rise. And then, so the last thing is like, what does the government do? And does it do something about both pensions and social welfare payments, which again would be something else which would start to boost the household share? And there's room, I think, to do that by basically taxing the corporate sector to pay for it. So it doesn't necessarily need to be a big fiscal ease, but it would be effective, I think, in helping the household sector in a way that hasn't happened until now. Now, is that all possible with whatever is happening with the kind of the turmoil of the politics side? It's more difficult now than it was a week ago, you would think. But I think that's what, again, if you think about the things that would be exciting in China, that welfare side is important. In Japan, it's sort of similar to that. If they can have a fiscal policy on the household side, I think that would make Japan quite interesting over the course of the next couple of years.
Are any of the factions talking about some of these policies that you've described?
So there's definitely, I guess to the extent that they focused on household incomes as being a big issue, right? Like, and so that whole thing. I haven't seen the details of what exactly they would be proposing, but I think at least it's in the ether, right? Like at least it's sort of in, and presumably is then going to be on the negotiations as they try to reach the government. So I think it's sort of, there's some reasons to be optimistic, but clearly it's not enough to have conviction when who knows who the Prime Minister is going to be.
And then on the BOJ, the market at one point was very excited about rate hikes. There was even talk maybe in October, but now the market's essentially given up on rate hikes. I mean, the interest rate curve is pricing kind of one hike maybe in the next 12 months or something. I mean, what's your view on the BOJ?
So I certainly think if you so before tariffs, and then let's say that the BOJ Tankan, so before the most recent election, like if you look at any of those, like either, so let's say March this year or October this year, like it all ticks all the boxes, right? It's difficult to say, it's difficult to give an argument why they wouldn't raise rates, right, on those things. Now, obviously, after March, you had tariffs, so fine. And after October, you've had this, so, well, maybe fine. But I think, again, in a way, like, I think the thing that stands out is it doesn't really add up, right? Like, unless you think that this political noise and the tariffs are really going to cause big damage to the economy over the course of the next 6 months. Otherwise, you have a situation where the BOJ really, I think, should be hiking rates. That the inflation side looks very solid. If anything, even before this recent bout of yen weakness, like the inflation numbers, I thought we might be seeing a peak, but it still looks like the inflation numbers are quite strong. Like the Tankan output prices are quite strong. 5-year inflation forecasts in the Tankan are quite strong. The BOJ's, the measure of the labor market is still the tightest it's ever been, like all of that stuff. So there's nothing really that is suggesting that the inflation that they've seen is going to come down, particularly in the underlying way that the BOJ talks about. So in a sense, I think the market's going to have to move again, right? Again, unless you think that this political stuff is really going to destabilize the economy. Otherwise, they're more at risk now of being behind the curve than they were, during the tariff stuff. Because at least tariff stuff, there will maybe something's going to go wrong, but that hasn't happened yet. So I think the market's going to have to move and price in hikes again. But they're obviously not. The market's obviously not going to do that until they have some visibility about where the politics is going to go and what the government's policy towards the BOJ is going to be. So, and I guess the other thing to be looking for is a steepening of the curve. If they do give if that is the economic picture, and they give all this pressure to the BOJ saying, well, you can't raise because, whatever, like the market's going to have to price something, right? Like in that scenario.
And how about the Japanese yen? Every time you think that the yen can't go any lower, we have another series of events, and the yen ends up at new lows against the dollar or against the euro and other currencies. Any thoughts?
So again, I think it is that, so the something needs to change in the sense of that what gives the BOJ, both the politicians and the BOJ, this sense that the economy is on a decent plane. And, so some of that is, again, it's not their fault that the US put all these well, I guess Trump would say it is their fault, but it's not really, they didn't cause the tariffs to come into play. So there was some uncertainty. But I think again, like it sort of comes back to this consumption side. So if the economy is ticking all the boxes right now for rates to go up, the one area of weakness is, GDP hasn't really grown at all, right, in the course of the last 5 years, partly because aggregate consumption is so low. So to my mind, it's kind of this, if there is better policy towards the household sector, aggregate consumption starts to rise. At the same time as with a stable yen, some of that headline inflation risk comes off. That sets the BOJ in line to be able to hike it, to not just in sort of this like volatile way over the course of the last couple of years is like one hike and then we'll see, and then something happens and they don't hike. So more in terms of the market can start to price like, actually, there's a decent story here. The economy is really recovering. There's something to kind of buy into. So again, I think it's either going to be because the yen sells off too much from here. And again, like the market has to price something in, or that the politicians sort of get their act together in the sense of doing something with fiscal policy that puts the economy on a better, even train of growth. And then I think, so in a sense, like we have enough right now to get one hike. I think if you get these other events coming in, then you can see a path to get above 1%. but I don't think the ducks are in line at the moment to say we're there yet.
Now, for years we've just focused on Japan and China as the big Asian economies, but obviously in the recent years, because of the AI boom, Taiwan's coming to the foreground, especially due to its world-class semi sector. How I mean, is it fair to say Taiwan is just the a one sector, one company economy? Is that a fair characterization?
I think that is a fair characterization. I mean, obviously, like, not to all these other people who work in Taiwan, but like, like it's mad. I mean, it's sort of crazy how. I mean, I think again, it's one of these things that, because this is what I do, right? This is sort of stuff I look at. So, I mean, in a sense, it is underappreciated because it's very niche. But the I mean, the numbers are off the charts, right? Like it's been not, the export boom to begin with during COVID, so the whole work at home thing, and then the AI this year. I mean, it's remarkable how strong export. I mean, exports in Taiwan have been the strongest since the 1980s, right? Like stronger than in like the WTO China boom. So, like it's really like astonishing. But it is all TSMC, right? Like it is all semiconductors. If you look at the export sector, nothing else is growing. It's only semiconductors and servers that are growing. So how to think about that? I mean, in one sense, like, this is the manifestation of very wise industrial policy back in the 1980s. On the other hand, you can sort of think about all these things, right? Like how do you think about the Dutch disease, right, in the context of Taiwan today, where you would think that with this hugely dominant company, like you would end up with this massively overvalued currency. Instead, you have this hugely successful company and a really undervalued currency, keeping a lot of SMEs and other businesses sort of going on. But with that policy, I think it's one of the things that interferes with the economy being able to move on from semiconductors in the future. So I think right now it's a great boom for Taiwan. The economy is doing very well, but it's a big risk for the future unless something changes. Because presumably AI is not going to be like this forever, and at some point, then that's going to be a big risk for the economy.
And the US, other countries, China, everyone's trying to replicate TSMC in some way. I mean, why is Taiwan being able to do this? Have this sort of amazing fabrication chip sector.
Well, I guess you're better off speaking to the tech people about that. But in terms of like the specific reasons, I mean, they had industrial policy back in the day. They got lucky having Morris Chang, who had this amazing idea for foundry, and it worked so well. Taiwan is a small place, right? On all the kind of the labor regulation not being what it is elsewhere, and so on. So all of those things have helped. So that's got Taiwan a long way. But if you think about, and this is kind of I think maybe the interesting way to think about Taiwan's economy, if you look at GDP per capita on a PPP basis, it's like paradise, right? So if you don't move from Taiwan, you don't travel, and you don't compare your incomes with your family members working overseas, and you just stay in Taiwan, like your income is now 90% of US levels, right? And just going up every year, it improves. So so in this sense, like TSMC and this whole model has been fantastically successful. On a US dollar basis, per capita GDP is only like 40 to 50% of US dollar levels. And obviously the difference between those two things is the exchange rate. So I think there is an elephant in the room when you think about Taiwan. It's been very successful so far. I mean, I had a conversation a couple of weeks ago with somebody talking about how the government is now looking for the next industry. And it's like, well, you got lucky once. It sort of seems like a bit difficult to think that you're going to be able to replicate this in, I don't know, biotechnology or something, right? So you would think that they probably need to think about the economy differently, but it's not clear that officials are yet into doing that.
And on the currency, in all metrics, I mean, the currency looks incredibly undervalued. So when will the turn happen? When will we see this big appreciation trend to reflect, this chronic undervaluation?
So I think it's kind of like the boiling frog, right? Like, so if you think about so 10 or 15 years ago, there was a big external surplus, but you could definitely make reasons why why the currency wouldn't move, and basically because there was still deflation, right? So if you're the central bank, like, why would you want the currency to appreciate? It's a bit like China today, right? Like the CNY is probably CNY should be going up, I think, appreciating. But why would you do that when there's still deflation? So that was the situation in Taiwan, like until sort of 10 or 15 years ago. But if you think about it today, like there's basically three things sort of, boiling the frog. So the first thing is Trump. And so this sort of increasing pressure from the US, right? Like, and obviously the Taiwan stuff is the Taiwan economic negotiations are complicated by whatever they're doing with China. But certainly there you would think that the atmosphere coming from the US is more about currency appreciation than it has been before. The second thing is the external surplus is just off the charts. So, current account surplus of 15-20% of GDP, trade surplus with the US at 10% of GDP. Like it's all sort of, madly high numbers. But then the third thing I think is maybe the kind of the icing on the cake is it no longer seems like the economy is sort of desperate for a weaker currency, right? Like there is some inflation. It's not inflation as in the rest of the world, but core inflation here between 2000 and 2020 averaged 0.4%, right? It was the economy that looked most similar to Japan, whereas inflation since 2020 has been about 1.5% for core. Wage growth does look like it's accelerating, led by the manufacturing sector. So you've got that kind of maybe some feed through from the manufacturing sector to services happening. So these three things in themselves, they don't determine where the exchange rate goes, because the CBC is obviously powerful and everyone here is sort of long dollars. And so, it's sort of, as long as they continue to think that that's the way to go, the currency doesn't change. But we can see what happens in April when some jitter happens, because these other things are now lining up for the currency to go stronger. So my bet would still be that the currency goes stronger. And if it's just between, and thinking about that, it's not just between 28 and 33 to the dollar, right? Because that's where we've been for 30 years. It's something beyond that. But it's both sort of market forces and market participants feeling that the central bank is comfortable with a stronger exchange rate. That's the combination that ultimately drives the currency to go higher. And so that's sort of trying to work out where we are in that process, right? I think is where we are right now.
And earlier, when we were talking about China, Japanification, you said actually Korea could actually be closer to Japanification. And I've seen in your work, you talk about the 3Ds. Can you talk a bit more about that?
So there's two things. So one thing I talked about a little bit earlier, which is like on the corporate side. And so that this kind of move from like having a fiscal deficit of a financing deficit of 15% of GDP to something which is much nearer flat now. So over the course of the last 30 to 40 years. Now, obviously, that's a structural change, but I think it's something that's reinforced by all the competition that's coming from China. But it's more like, if you wouldn't think that Korean companies right now would be feeling hugely confident about going and make big new investments, right? Like, so I think that sort of is reinforcing that trend. Why is that important in terms of thinking about Korea more generally? Because if you think about it, right, Korea hasn't been like, you can talk about East Asia, right? Like, and obviously I try to do that because that's what I've named this, the small thing that I do. But actually, Korea wasn't really in that pack, right? Like, it had high inflation, it had high wage growth, it had a current account deficit, it was a net borrower from the rest of the world. Very different from the rest of the economies. Whereas if you look at today, this change in the corporate side, I think, puts South Korea much more closely aligned with the rest of East Asia. That you now have this kind of, structural current account surplus economy, structural saver in a way that wasn't the case previously. So I think that's one important change that's going on. And then the second thing, so that's kind of relates to then the second thing of these kind of structural things, the 3Ds. So, somebody else was talking about this for China recently, but the 3Ds back in for Japan in a day were debt deflation and demographics. So in Korea today, you have the demographics, you have the debt in the sense that private sector debt is now as high as it was in Japan back in the mid 1980s, which I wasn't aware of until I read this PBoC paper. Obviously, a lot more of it's held by the household sector rather than the corporate sector, but the debt level is high. And then the third thing is this idea that this development model is challenged by the rise of China and what's happening with tariffs. And so the PBoC research all talks about how potential growth is slowing. It's 2% now. It's like to slow much more over the course of the next 20 years because of all of these things. And if you've got this backdrop of becoming a net saver at the same time, like it kind of like in this sense, I think feels much more similar to the risks around Japan, and particularly if because right now the thing that's holding up rates. I think two things holding up rates for the market point of view. One is obviously the housing market. So the BOK saying like housing is re-accelerating, well, we can't cut. The second thing is CPI still hovering about 2% or thereabouts. On the housing front, I think it's particularly important, right? Because this is the debt side. So if, presumably when at some point this starts to unwind, it's that I think that takes the floor away from rates, right? Depending where we are in the cycle. But structurally, it will be a big thing for the markets because if housing doesn't, I mean, in a way, housing feels a bit like China's housing back in the day, where it never really slows down, and people always believe it's going to go up. And we can see in China that finally that doesn't last. And if that changes in Korea, then the rates change, I think, in Korea becomes really interesting because it's like, where is,
in the case of China, you could
is?
say there was a policy-induced correction. We had the three red lines all those years ago. It seemed like there was a bit of a policy intervention. Whereas Korea, it's not so clear to me whether they'll sort of do like a housing policy intervention.
Yeah, so I think China, you could maybe say I mean, there's obviously different views on this. Like my sense, I mean, if you think about China policy over the years, like for years they tried to slow it down, right? For years,
that's fair. Yeah,
they tried everything, and then so whether this was like the policy that really made a difference, or it was the kind of the final nail in the coffin, I think depends on your view. But anyway. And then also on Korea, and they're obviously taking all of these macroprudential measures all the time to try to do something about it. And I guess at some point it will be whether there's another rise in inflation and interest rates go too high and they can't cut quickly enough, right? There'll be some thing that will derail this at some point. And then I think these structural issues, and it's interesting, right? The BOK is talking about this. Like good research, like lots of recommendations. I mean, too many recommendations, is the problem, right? But there's too many things they should be doing. But it's clearly on the agenda for the BOK, and therefore these are significant issues. And to my mind, this sort of the structural issues facing Korea's economy feel much more serious than the structural issues facing the economies elsewhere.
That's great. Now, we've covered so much ground, so I did want to just round off with a couple of personal questions to sort of make this podcast sort of end on a fun note. A couple of things. One is you've been in markets for a number of years now, buy side, sell side. You're in Taiwan now. I mean, what's the best investment advice you've ever received from anyone or heard from anyone?
I think it's maybe a bit obvious, but the thing. So, because when I was at Wellington, right, like the approach in the team was they were the risk takers and there was the strategists. So I was a strategist, and the idea of that sort of differentiation of labor was to make sure that the strategists weren't weren't attached to their view, that you could change your view very quickly. Now, in reality, it's never that simple, right? Because you still have reputation and people still listen to you and all of that. So, but I think that's the sort of the most important lesson is like you just got to change. If you're wrong, get on with it, right? Like change your mind and tell people you're wrong. And, because there's no point. I mean, I remember, so I made this big mistake, right? Back in 2008. So I was very excited about China. And, there was this thing of like, it was all about property, right? And like, if you think going into 2008, early 2008, it was this thing like real rates were really low, right? Like because inflation was accelerating, they weren't tightening very much. But actually, and so I was like, real rates, this is going to be like an even stronger story. And obviously what happened was, and actually the data showed from early 2008, the property market was already starting to reverse. So that to me, I mean, there's other mistakes I made, but that was definitely one of the things that sticks in my mind. You just got to got to change your mind, right? When you're wrong and move on.
No, that's a great point. Now, some of our audience are relatively young, and many of them will be leaving university either sort of recently over the summer or in the upcoming academic year. I mean, the world's changing a lot. I mean, what advice would you give them as they enter the real world?
The real world, yes. So, and I think, the three things I think yeah, I would have liked to have done better. So I think when I was young, I had more patience. So I mean, my dad would say, oh, I took too long anyway. But went to China for a year and wasted time. But I think it's better to take your time to learn skills. It's easier to do that when you're young than when you're older. So I think that's one thing that stuck with me. The second thing, which I'm terrible at doing, is networking, which is particularly when you're trying to run your own business, right, is very important, and I'm terrible at that. So definitely try to do that well. And the third thing, which again I'm not very good at, I think, but have just confidence in yourself, right? Like you've got to believe in yourself. So in a way, another investor I used to work with, he says to his kids, right, you have to he tells them, you might screw this, be confident, but remember you might screw this up. So it's kind of a combination of you've got to be prepared, but you've got to believe in yourself, but you've also got to do the work, right? And be prepared. I think that's sort of quite a useful balancing act, but you've got to get right.
I like that. Now, I notice you have some books there on the bookshelf there. I'm a massive reader. And so what are some of the books that either influenced you or recently you've come across that you would recommend?
So I've just been reading this really good book from the 1980s, and I'm going to pronounce his name wrong. I always think it's Chalmers Johnson, which I suspect it sounds like too good to be true. But it's this book about MITI and basically industrial policy in Japan. It doesn't sound like a very exciting title, right? But it's a really good book, and you learn so much about both Japan, but also the parallels with China. So I mean, I thought it's really insightful, really good. So I think that is sort of a work thing. And then the other book I like, mainly because I think it would be nice to be able to do something similar for China, but I haven't really worked out a way to do it. But it's that Lords of Finance book. Do you remember that?
By Liaquat Ahmed.
Yeah.
That was an amazing book. Yeah.
Yeah. And the reason I like it's a great book, but and there was a great line about the gold standard and making up this value of gold over breakfast, right? Which I always thought maybe is how they do the CNY in China back in the day. But in any case, but the reason I liked it, the other reason I liked it is because it's it tells economics through an interesting lens, right? Because these four guys were really interesting characters, had interesting lives. So you learn a lot about economics, but in an interesting way. And I always think it would be nice to be able to do something like that on China. But obviously, access to people in China is much trickier, so I'm not sure, but yeah, I really like the book.
Yeah, and then finally, tell us what you're up to, what your consultancy does, how people can reach out to you, and so on.
So so I have this little company, East Asia Econ. So eastasiaecon.com is where you can find out most of the information. So I've spent a lot of the last 3 to 4 years building up this data infrastructure. So learning Python, which maybe you don't need to do that anymore because of AI, but in any case, so it's all sort of, and it took ages to get it all together, but now it works quite well. So I'm using that to do a lot of sort of cyclical analysis, but also to try to think about these structural issues. And so, for example, Japanification and what's happening with Korea and the structural issues there, the monetary policy stuff in China right now. So if you're interested, then check it out, eastasiaecon.com.
Yeah, I've only recently come across your work, and I'm a huge fan. So I'd really recommend everyone to go to the site. I'll also include the link on the show notes for this podcast as well. So with that, Paul, fantastic having you on the podcast. Keep up the good work, and good luck for the rest of the year.
Great, thanks very much. Nice to see you.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'll be very, very grateful. And of course, sign up for our free newsletter at macrohive.com. And this podcast is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information and although obtained from sources believed by Macrohive to be reliable, its accuracy and completeness are not guaranteed. Past performance is not guarantee or indication of future results. Third-party opinions expressed expressed in this podcast are solely those of the speaker and do not represent the views of Macquarie, BGC Group, or any of its affiliates. And this podcast may not be copied or distributed in whole or in part without the express written consent of Macquarie. All rights are reserved.